Budget 2027. It's been handed down and there is a lot of uncertainty about what it's going to mean for business owners, for individual taxpayers, those who own investment properties, those who have taken chances in life to try and get ahead. So what does the budget mean to you and how is it going to impact you in the years coming ahead? So guys, I have put together a series of short reels which will go out on our short content platforms in the next few days. But I've decided to bunch it all together as one whole video so you guys can watch it now, soak it up, and just really get a complete, straightforward, no accountanese, but just plain English, your language, on how this budget's going to affect you. Please, if you've got any questions, throw in the comments. This is stuff that then I'll go back and record future videos on to answer your questions so I can best serve you as your accountant.
If we're not growing, you're not growing.
Guys, if you thought capital gains tax was confusing before budget night, I'm sorry to say it doesn't get any less confusing. Now, before budget night a few weeks ago, there was speculation that the discount was going to change to 33%. I'm just going to say 33% was an absolute dream compared to what it is now. So in this example, I'm going to be talking about if you held a property before budget night, just passed, and then also you sell your property after July 2027, I want to run through with you how it's going to work when it comes to calculating your tax and also look at the difference of where you're at. So it's good to know that, hey, look, pre-30 June 27, nothing really changes. So let's assume you're going to sell the property for 1.1 million around about July 28. There's a few things you need to do before we even do any calculations. First up, you need to get a valuation done at the 1st of July 2027 by a professional valuer to work out what that value is. And the reason that is important is because the calculation is going to be done in two different sections. First up, we're going to have our grandfathered CGT rules. And if we said that the property was worth $1 million at that point in time, and it originally cost us 500 grand, the capital gains tax, just like the old system, would mean that 250 is taxable at the highest tax bracket, 117,500. But go our post 1 July 27, there is that additional 100,000, because remember we're selling for 1.1, that additional $100,000 is going to get taxed somehow. And the way it's going to get taxed is via the CPI indexing method. And effectively, let's assume that in that 12 months that there is a CPI increase of 3%. So we're going to take that $1 million and then multiply it by 3%, which is 30 grand, which means that the new cost base of that second part is $1,030,000. So effectively what we're going to do is we're saying we've made on that extra 100,000 after 1 July 2027 of $70,000. So we've got our 100 less our 30 equals 70. Now, the way we calculate the tax is that it would be our pre-July capital gain, which is the 250, plus our 70 is 320, multiplied, assuming that we're on the highest tax bracket of 47%, and that is your tax, 150,400. Whereas the previous system, if I worked out the same tax, it would have been 141,000. So there is an absolute difference there of an additional tax of 9,400. Look, you guys run the numbers. There's going to be various different examples of how this could pan out. Let's go through all the other aspects of how capital gains is going to work for you in the future, assuming the budget passes both houses of parliament. Now, effectively, there are a few things to do to get through here. So what's going to happen from now if you sell a asset, shares, whatever it might be, might even be crypto, there is a cost base that we associate to work out how much of a gain you've made on selling that particular asset. And that's what you get taxed on effectively. And so from now, what we're going to do is we're going to say, whatever you sold that asset for, we're going to take away the original amount you paid for it, but then we're going to add additional amount, which we call inflation, on whatever you bought it for, just to bring it back into kind of like for like on you selling in the same year. Now, effectively, what tends to happen is when we talk about inflation on average in Australia grows around 3 to 5%. So that means on every year, your asset, your base value of your asset should grow to 3 to 5%. And that is how we're going to work out your cost base of your property. The other thing you're going to want to know is if you sell a asset, any capital gains, anything that is effective under the post 1 July 2027, the government is going to say, we want a minimum 30% tax on your gain. So your calculated gain, we want 30% tax. So if you find yourself under a smaller tax bracket, or possibly you are in a position where maybe you've just slowed down, you're doing less work, you might be in a lower tax bracket, but still on that proportion of income, they are going to take 30%. Except if you fall under a government support payment person. So that could be like maybe you're on some form of like maybe New Start allowance or maybe old age pension. But if you get that, you are exempt and you won't need to pay that. Crazy, I know, right? So not everyone is captured. Lastly, if you do find yourself buying a new property, as per my previous video, we talk about negative gearing for new properties post 1 July 27, you get to choose whether that capital gain in the future will be under a 50% discount or under the indexing method. And lastly, I do have some good news. The main residence exemption is exempt, but it is not being changed. Everything there is exactly the same. So your family home, if you move out, you rent it out, essentially for less than 6 years, you move back in, typically there's no capital gains tax on that. Investment properties is big discussion at the moment post budget. And if you have a rental property already, look, the good news is there's going to be no changes on how negative gearing is done for you and your property. Now, if, say, for example, post the budget night, if you've entered in contract pre-budget night and you've exchanged that contract, you will be under the old rules of being able to negative gear that property and have that loss. So even if it hasn't settled as yet, as long as you've entered in a contract before budget night. Now, guys, I'm here at the moment. I think this is close to my home here. There's two different properties here. This was a house that was knocked down and some beautiful new duplexes. And over here is an original house that was purchased. And you can see if I zoom in, they seem to be building or turning this house into a duplex. Now, here's the thing. This house here clearly is going to fall under that new regime. If someone buys this after effectively the 12th of May, they're going to be fine with negative gearing. Maybe that house there behind me, this one behind me, are they not? The devil is in the detail. But I guess all you need to know is if you do currently hold a property at the moment, that negative gearing is still going to work the same. If you're buying a new property post 12 May, if you want the negative gearing, it's going to have to be a new property. Now, one thing I've always believed in is, look, negative gearing can work, but I also think that you're always going to be in a better position if you can have a property that's positively geared, which means it makes money, it doesn't make a loss. But negative gearing, what it typically does is it just makes that property more affordable when we start adding in things like depreciation and maybe the interest on the loan. I'm going to go dig deeper. So here's the scenario right here on my board. Effectively, there are two types of houses here. We've got essentially the house that was, let's just say that's the red brick one, our old house that is not a new supply house that adds to the current housing we've got out there, out and about in our great nation. Now, here's the thing, right? Is your negative gearing going to continue to happen? And it really depends on when you bought it. So if you had bought your property before the 12th of May, 2026, there are no changes. You have nothing to worry about. You can continue negative gearing. If, however, you have entered into a contract to buy an investment property after the 12th of May, your negative gearing effectively is fairly limited, next to nothing into the future. And what I mean by that is that from up until the 1st of July, so basically if you bought it now and exchanged and settled before the end of this financial year, you're going to have a little bit of negative gearing and rent in the 2026 financial year. And then in the 2027 financial year, you can have that whole year of negative gearing. But after the 1st of July 2027, nothing, no more negative gearing for you on that property. But if you happen to have purchased, and this is, I'm going green because the government's all greeny and yeah, anyway. So if you bought yourself a new property and that is like a new build, no one has lived in it before, you most likely bought it off the plan. It could have been from a property developer. Maybe you went out and did it yourself. And this one here is a little duplex, right? Effectively, the way that is going to work is negative gearing is going to work from you from day dot until you buy it to when you sell it, effectively. Now, what sort of property can you do under this? It could be a property. In my video, I talk about a house that was, I didn't know whether it was basically a house that they've extended. And I've got down here, if it was significantly, if reno was done, it significantly was to change and it was to increase supply. So there would be an increase of supply there. So logically, you would think that it would be able to be negatively geared, but essentially it needs to be a new build. Now, here's the thing, guys. If you do find yourself in a property that you can't claim the negative gearing, you can roll that negative gearing over into future years, and you will be able to offset that against other rental income in the future or any capital gains. The budget has allowed for the instant asset write-off to continue into the future. So effectively, there's no real change. It's currently $20,000 instant write-off for the 2026 financial year. It's going to be the same for 27. It's going to be the same for the 28 financial year. But here's the thing. You need to understand, first up, to be qualified, you need to have turnover of less than $10 million. So let's go through an example based on the idea that we have a company with a 25% base tax rate. And first of all, actually, I want to just also confirm, if you're registered for GST versus not registered for GST, the amount on what you're buying can differ greatly. And here on the board, let's just demonstrate that. If you are a business that's registered for GST, effectively you could buy something that's $22,000, get the $2,000 GST back in tax credits or GST credits when you lodge your BAS, and 20 grand is the amount that we're claiming. But if you are running a business where you're not registered for GST, it's $20,000 including GST. So please be aware of that. Don't get yourself caught out. Now, let's talk about the impact on what it means in the immediate future, now and then long term, right? So straight up, in that first year we claim it, assuming we're buying a coffee machine here for a cafe, year one, we get 20,000. It's effectively, if your tax rate for a base rate company is 25%, you're getting 5 grand back, right? 5 grand less tax. But what I want you to be aware of is that if you're not paying this out of cash, so there's no retained earnings in your business and you need to borrow money, there are going to be repayments, and those repayments are not expenses on your profit and loss. So you imagine those repayments are not there, there's no tax on those repayments, but in saying that, there's still cash coming out of your business, which means that there's going to be a tax impact. And what I've worked out is over a 5-year period, the repayments on a loan for a $20,000 coffee machine might come to $24,332. The interest impact after allowing for what you're going to get back on tax would be $1,083, which means there's $23,249 over those 5 years that's going to be taxed, right? Because it's profits, it's money, it's no tax deduction there because you've already had the tax deduction up here. So effectively what that means is if we take that $23,249 and we multiply that by 25%, it's going to be $5,812 of tax, or about, I think it's about $1,600 over each year average, right? But you can see the difference. So to do this, it's going to cost you $812 over the 5 years. For all the crap that's been in the budget, let's talk about some good news. Let's continue on this instant asset write-off. But I want to talk about how we can use and this is, I'm copying this word for word, the government's loss refundable support for cash flow for businesses in the 2027 financial year with companies that have turnover of up to 1 billion, where they can use their current year tax losses, that would be in the 27 financial year, for a refund on tax paid in the prior to income tax year. So that would be the 2026 financial year and the 2025 financial year. So guys, if you have had a profit in the 25 year and they're having a profit in the 2026 year, you can predict that, right? So if you have losses in the 27 financial year, effectively you get that tax back from those previous really good years. But what I want to talk about is how, and this is basically in their finance documents down on the government's website, where you could manufacture a tax loss by actually helping, by improving your business, by bringing in the instant asset write-off, maybe buying some equipment in the business. So let's talk about an example. Let's continue on my cafe where we've purchased a coffee machine. Now, in addition to that, we're buying also some tables and chairs, and it's costing $22,000 for the coffee machine. It's costing $16,500 for the tables and chairs. Now, there's GST in that, assuming you're registered for GST, and this is obviously you've got to be a company for this too, right? You're going to get $3,500 of GST back when you do your BAS. Now, in addition to that, you're going to be able to claim each one of these. They're different assets. You can go each one, right? It's not just 20 grand total that you can do the instant asset write-off. So we're going to basically write off $35,000 in tax deductions in that 27 financial year. Now, what I love about this is effectively, let's assume that our company for the 27 financial year has a loss already of $5,000. Plus, we're going to instantly write off 35, which means that we now have $40,000 of losses. And if we multiply that 40 grand, the tax effect of that by 25% being the base rate, it is $10,000 of benefit. Now, assuming in the 25 or the 26 financial year you paid, let's assume you paid $12,500, but you need to have paid this tax, right? You could use part of that, obviously up to $12,500, you could claim that back. So in this case here, we're going to claim 10 grand back. We've used 10 grand to help fund improve your business. The budget has been handed down and there's been a massive attack on family trusts. And you know what? If you are in business, this is like the bread and butter. This is the basic setup that most people in business who are taking risk to operate a business, and these are mum and dad businesses. These are people who have not a huge amount of businesses. They're not the big end of town. This is how you would typically set up a trading entity, a business, right? We would have a trading entity, corporate company, and we do that for the limited liability, right? We would have the shares of that company held by discretionary trust, and effectively, after paying really good, I would say, market wages to the owners, those who are working in the business, any profit left after that, we would go, hey, let's pay that to the beneficiaries of the trust. Now, if you had some kids, you might pay them, and when I say kids, like under 18, you might pay them $416 each, which is tax-free. You might pay your spouse, who's maybe is not working full-time, not on the highest tax bracket, so you want to take advantage of their tax bracket. And then it might be also yourself, depending on where you're at. It might be your mum and dad. A lot of times, because they're on probably maybe a pension or something like that, it might affect them, maybe part pension you might not distribute to mum and dad. But particularly as well, bucket companies. Now, we do that a lot as accountants. And the reason we do that is because then we can use that vehicle to reinvest money again and just recycle profits through to basically really cut tax down and really cap the tax that it's earning at 30%. So if I was to look at what we typically would do before all of this, and by the way, this doesn't kick in until, assuming it's passed in legislation in Parliament, until 1 July 28 after that, which is the 29 financial year. But what we would do is we would distribute, say if we had like a dividend of 100,000, which includes a 25 grand franking credit, we would basically go, hey, let's distribute it here. The $416 we give to, maybe we've got 3 kids, that's all tax free. We might put it to the spouses on a lower tax bracket. Maybe that spouse is paying less than, on average, a marginal rate of 30%, and they put some in the bucket company. Now, where it all falls horribly wrong is effectively when we start distributing all this money down, the discretionary trust automatically, before it distributes any money, it's going to pay 30% tax, right? Now, that 30% tax will be passed down to effectively these people here, right? And it'll be a non-refundable tax credit. But if you distribute to a bucket company, you're going to pay 30% tax there, and that non-refundable tax credit is not going to come down here. Massive changes. Guys, what do you think about this? Is Albo ruining the country? Let me know in your comments.